Welcome back to the Commodities Institute podcast. I'm Emily Costa and it's Wednesday, December 3rd, 2025. Thanks for joining me for another deep dive into the currents shaping global commodities. Today, we're slowing things down, taking a thoughtful walk through the biggest developments across oils, agriculture, carbon and power and freight. And as always, we'll unpack not just the headlines, but the underlying forces that matter to traders, producers, and policymakers. Let's begin with something slightly outside our usual order, because it represents one of the most consequential policy shifts in oil markets in years. OPEC Plus is reinventing how it measures capacity, and the implications ripple across everything from future supply projections to diplomatic alignment within the group. OPEC Plus has agreed to launch annual production capacity assessments beginning in 2026, which will serve as the foundation for output baselines used in 2027. For a group that has for years wrestled with resentment over perceived inequities in quota assignments, this marks a rare moment of institutional evolution, and a critical one. The United Arab Emirates has invested heavily in expanding its capacity and wants recognition for that. Several African producers, meanwhile, have seen their fields decline, and others are deeply resistant to lowering their theoretical capacity, even when their wells no longer support the numbers on paper. Angola's dramatic exit from OPEC last year over quota disagreements underscored just how unstable the old system had become. To rebuild credibility with markets, OPEC Plus will bring in outside auditors. The group plans to appoint the US consultancy DeGolyer and McNaughton, well known for auditing Saudi reserves ahead of Aramco's initial public offering in 2019. That firm will evaluate capacity for 19 of the 22 member states. 3 countries, Russia, Iran and Venezuela, will not be assessed by a US company due to sanctions and political objections. Instead, an Indian firm will likely take on Russia and Venezuela, while Iran will rely on production figures to assert capacity. These distinctions matter because they hint at a new, more multi-layered OPEC Plus, one that balances politics with pragmatism. The group is acknowledging internal differences, but choosing to bridge them through flexibility rather than fracture. That's no small feat during a period when 12 of the 18 members with quotas pumped below target in October, and when spare capacity across the group continues to shrink after years of underinvestment. With production rising again in 2025 after a long stretch of cuts, the gap between official quotas and actual pumping has widened. Consultants will help anchor the numbers in reality and reduce the gamesmanship that has long clouded the organization's transparency. For traders, this may lead to a steadier forward curve and better alignment between rhetoric and physical supply. Now, staying in the oil space for a moment, but shifting the focus, there is another story unfolding in Iraq, one that could reshape the map of investment in one of the world's most strategic oil basins. ExxonMobil has quietly expressed interest in buying Lukoil's majority stake in the massive West Corner 2 oil field. This field is no small asset. It produces roughly 470,000 barrels per day, about half of 1% of global supply, and almost 1/10 of Iraq's total production. Lukoil, under US sanctions pressure, has been looking to offload its overseas holdings. The US Treasury has granted a narrow window for potential buyers to explore talks. Exxon stepping in here would mark a significant return to Iraq's upstream sector after exiting the neighbouring West Qurna project last year. Baghdad, for its part, seems eager for this reunion. Iraqi officials have signalled that Exxon is their preferred operator, praising its technical depth and experience managing complex reservoirs. This moment is especially symbolic because Iraq is actively courting Western majors again after years of strained relations. With more generous contract terms now on the table, the country is trying to accelerate both oil and gas production. For Exxon, the opportunity sits at the intersection of timing, geopolitics, and commercial logic. For Iraq, it's a chance to stabilize output while diversifying foreign partnerships away from Moscow. Let's step away from hydrocarbons now and move into metals, where cobalt continues to be one of the markets most defined by contradiction. On one hand, prices have soared this year. On the other, the long-term structural demand picture looks increasingly fragile. The Democratic Republic of Congo, which produces about 70% of the world's mined cobalt, halted exports nearly 10 months ago. While that morphed into a quota system in October, material still has not begun flowing because producers are waiting for green lights from Congo's Minerals Authority. This bottleneck alone has sent spot cobalt metal prices climbing from roughly $10 per pound in February to about $26 per pound. Cobalt hydroxide, Congo's primary export form, has jumped from roughly $6 per pound to around $23. The intention behind Congo's new quota regime is clear: more control, more value capture, and less vulnerability to price collapses. The risk, however, is that the process drags on too long. Chinese processors who depend on Congolese output have seen their inventories erode rapidly. Imports from Congo to China in the June to September period totaled only 50,000 metric tons, less than a typical single month previously. Even if shipments resume today, material would not reach China until late in the first quarter of next year. This crunch lands at a particularly delicate moment because battery chemistry is changing. Chinese electric vehicle makers are doubling down on lithium iron phosphate batteries, formulations that need neither cobalt nor nickel. Forecasts suggest that these LFP chemistries could rise from just under half of the EV battery market today to nearly two-thirds by 2029. Even in nickel-rich batteries, cobalt ratios continue to be trimmed. So while short-term scarcity boosts prices, the long-term demand outlook faces headwinds. Let's pivot now to agriculture, where both weather patterns and geopolitics are shaping markets. Russia announced that its gross grain harvest has exceeded 145 million metric tons this year because gross weight impurities and excess moisture, especially common in bad weather. The clean weight figure is expected to settle closer to 135 million tons. Even so, this is a robust harvest, with wheat alone expected to account for roughly 90 million tons. Better than anticipated yields in central Russia and Siberia helped offset drought losses in the south. At the same time, US farmers are waiting for clarity on federal support. Washington plans to announce what it's calling a bridge payment next week, a short-term relief measure designed to help growers cope with low crop prices and ongoing disruptions in agricultural trade. With more than $40 billion in farm payments already anticipated this year, the agricultural sector is receiving the second highest level of US support since the 1930s. But producers argue that more immediate funding is needed to secure planting for the upcoming crop year. The trade relationship with China is slowly thawing as well. Several US bulk carriers are scheduled to load soybeans for China through mid-December after months of stalled activity. A handful of vessels have already loaded or are preparing to do so, marking the first signs of renewed movement following political discussions earlier this autumn. Chinese bookings remain well below pre-trade war levels, but the uptick is notable and may lend some stability to soybean prices heading into 2026. One final stop on today's tour, the freight market. A group of Thai importers has issued a tender for up to 240,000 metric tons of feed wheat for shipment in 2026. With flexible origins excluding Russia, Brazil, Pakistan, and Ukraine, the tender highlights an ongoing trend among Asian buyers, diversifying supply chains and building more resilience into procurement strategies. Traders expect Thailand may not buy the full volume, but the tender itself signals an appetite for forward positioning in an increasingly unpredictable grains landscape. As we wrap up today's episode, it's worth reflecting on the common thread connecting these stories. Whether it's OPEC Plus turning to independent auditors, Congo recalibrating cobalt exports, or governments and companies reshaping investment flows, the broader theme is one of rebalancing. Commodity markets are adjusting to new geopolitical alignments, new technologies, and new expectations for stability. And while volatility remains part of the story, so does adaptation. Thanks for spending your time with me today. If you found this episode valuable, be sure to subscribe, share, and leave a review. I'm Emily Costa, and I'll see you on the next episode of the Commodities Institute podcast.